The Home Mortgage Disclosure Act holds significant importance for MLOs as it promotes transparency and accountability in the mortgage lending process. The Home Mortgage Disclosure Act, also known as HMDA, requires mortgage companies to collect and report data about their lending practices, including information on loan applications, loan approvals, denials, and other relevant details. By collecting and disclosing this data, HMDA helps identify potential patterns of discrimination or disparities in lending, enabling regulators and policymakers to address any issues and ensure fair access to mortgage credit. Additionally, HMDA data provides valuable insights into market trends, lending practices, and the overall health of the mortgage industry, facilitating informed decision-making and better regulatory oversight. Ultimately, HMDA plays a crucial role in promoting fair lending practices, preventing discrimination, and fostering a more transparent and inclusive mortgage market. The Home Mortgage Disclosure Act was enacted by Congress in 1975 and is implemented by the CFPB's Regulation C, and requires most mortgage lenders located in metropolitan areas to collect data about their housing-related lending activity. However, Reg C does have an exemption for financial institutions such as banks, savings associations, and credit unions who have assets totaling $46 million or less, which do not require them to report Home Mortgage Disclosure Act data. Lenders and non-exempt entities must report annually to the appropriate federal agencies and make the data available to the public. HMDA grew out of public concern over credit shortages in certain urban neighborhoods. Congress believed that some financial institutions had contributed to the decline of some geographic areas by its failure to provide adequate home financing to qualified applicants on reasonable terms and conditions. The predominant issue with this is that although the banks were accepting deposits from lower socioeconomic areas, they were not in turn lending the money back out in these areas. The acts of banks and lending institutions lending and providing banking only in certain geographic areas is known as the practice of redlining. The concept is that someone in a banking office standing next to a map with a red marker in hand, showing that he will or will not provide service in certain areas by circling them on a map. Oftentimes, banks would lend and bank in higher socioeconomic areas and tend not to do business in some economically challenged urban areas. The Community Reinvestment Act also works in conjunction with the Home Mortgage Disclosure Act to ensure that all customers have equal access to credit and banking by institutions. Thus, one purpose of HMDA and Reg C is to provide the public with information that will help show whether financial institutions are serving the housing credit needs of the neighborhoods and communities in which they are located. A second purpose is to aid public officials in targeting public investments from the private sector to areas where they are needed. Finally, this law requires the collection and disclosure of data about applicant and borrower characteristics to assist in identifying possible discriminatory lending patterns and enforcing anti-discrimination statutes. As the name implies, the Home Mortgage Disclosure Act is a disclosure law that relies upon public scrutiny for its effectiveness. It does not prohibit any specific activity of lenders, and it does not establish a quota system of mortgage loans to be made in any metropolitan statistical area or other geographic area as defined by the Office of Management and Budget. Before we begin discussing HMDA requirements and the compilation of loan data, you will be presented with Module 6's learning objectives on the next page.